Hey everybody, this is Jose Blasco here. Welcome to the session. Today is February 24, 2022. Welcome to the SMARTT Tiger Life session. One second, sorry for that. I was having the sound come back to me. Sorry for that. So welcome to the session. As I was saying, today we have in front of us a very relevant session, especially given the fact of what's happening in the world. Apart from learning options, today we're going to have very, very specific, useful, powerful application of options trading in line with a very special condition in the marketplace, which I'm eager to analyze together with you guys. My name is Jose Blasco. If I haven't said it, you can see my name and my email on the screen. Feel free to contact me if you have any questions after the session or you're watching this recorded. As we start, I'd like to check with you to have a quick test on the chat box just to confirm that sound is good, you hear me well, and you are ready to be engaged and interact with me. Could you please just have a quick hello on the chat box so I know you hear me well, and also I know more importantly that you are ready for today's session, because the idea is to learn a lot and to be well prepared for trading in general and more specifically with options. Before we get started, I also wanted to point at the upper left side of the screen where we have a disclaimer. I would like to ask you please to read it carefully. This is important information. Basically, what we're going to do, it's obviously we're analyzing the markets. In the end, the bottom line is that you taking a trade or not is obviously your decision. But while that's the case, I'm more than happy to work and collaborate with you to help you understand the pros and the cons and the various different possibilities that options trading and the markets provide. And I would assume that some of you are newer to trading. I would also assume that some of you are very experienced. And also I would assume that some of you are somewhere in between. So I am expecting all sorts of questions, advanced, less advanced, more basic, less basic. Please feel free to work with me. If, let's say, the answer is coming later, let me be the one to tell you, do not stop yourself from engaging and interacting with me, because that way you will take a greater advantage of the session, while it's going to be more fun for me if I can be just slightly selfish by getting your feedback. Okay, so thank you for that. Thank you for those hellos. Very good, very good, very good. Okay, so with that said, again, we have so many things to discuss, so let's jump into the agenda for today. So first of all, talk about the sequence of the session today. I'm gonna have a super brief introduction of myself, just so you know who I am, in case you haven't been in a session with me, maybe you didn't participate last week. We'll talk about key headlines, which obviously we all know what is the key headline for today with Russia, Ukraine, etc. So we'll talk about these more in depth, and most importantly, applied to the markets. Then we'll have a lesson on options trading, which is about selling options today, which is kind of a continuation from last week's lesson. Very important. We'll then get into the special market commentary. That's going to be very, very important for you to listen to. I have already a little bonus for you for towards the end of the session, which probably you will very much appreciate. But I'm not the only one with a bonus for you and a kind, a kind show of help. Tiger Broker as well. As you can see on the screen, there is a QR code here with a zero commission card for US options trading to help you get started and to be able to begin practice, because in the end, trading, like any other thing in life, it could be cooking, speaking a foreign language, whatever it is, it's all about knowledge, but also practice. Okay, and obviously the practice implied trading executions with your platform. So this is indeed appreciated. My name is Jose Blasco. In case you have not noticed, I speak fast. So again, I would assume it's okay if I speak fast, but if it's not okay, make sure you tell me, make sure you ask questions, you ask me to repeat. Again, many times in life, less is more. While my intention is to give you as more as I can, but if you need to slow me down or you need to speed me up, just feel free to interact with me in the chat box. I'll be reading throughout the session, even though we'll have Q&A at the end, but I will be reading throughout the session, and I may miss a question here and there, but I guess that it should be okay for me to get most of the questions live. I'm actually just having a little issue right now with my chat, which I am fixing, so I'm gonna be okay in a moment. Now, as a trader, I trade all asset classes. My favorite asset class is options. Options, as you saw written in the beginning of the presentation, options give you options, okay? And in that sense, having that level of flexibility in a market, which is a competitive environment, it's something that as a trader, I appreciate very, very much, okay? And in that sense, it's my little favorite asset to trade. And you will see some of the reasons why today. You can also see here on the web page. Sorry, let me repeat that. You can see here on the slide the URL to our web page in case you want to know a bit more about what we do as a company, the type of tools that we have for traders, etc., etc. Feel free to take a look, and you will know a bit more about that. Now, with all of this said, let's begin the session now. First thing first, headlines. Headlines means big titles. Later, we're gonna dive deeper into this, and more specifically, dive deeper into it using charts, meaning understanding the marketplace, which is really the key. But obviously, the first item in the list is the real key item, especially today, right? Russia, Ukraine, geopolitical tensions. The markets are moving crazy up and down, depending which markets. And as a trader, as investors, whatever we are, while obviously this is a situation that probably doesn't make too many people happy in the world, right? When there is a war, there is a conflict, it's not a happy news, right? But putting that on the side, from a trading point of view, we also need to learn to put distance between emotions, feelings, and all of those different normal things as a consequence of being a human being, and think about it from a business mind, think about it a little bit with a colder mindset, and think about, okay, the markets are moving. Well, that equals opportunity. How can I enter the market safe? I'm not saying the market is moving crazy, let's do something crazy. That's absolutely not what I'm saying. I'm saying the market is moving fast, it's volatile, okay? For sure, there is a level of danger, but if we know how to read it, there is also a level of opportunity, which I want to get into that later in the session today, so I can, help you hopefully understand better the environment, especially if you are not too experienced, or maybe you have not seen wars in the markets and things like that. So hopefully this will open your eyes very much. Another important headline for the ones of you trading earnings or holding stocks that are about to report earnings. Today, February 24, we got 250 earnings reports on the US markets, where probably the most relevant ones are the four I got in the bottom part of the screen, which is Into, NEM, Beyond Meat, and Alibaba Group in the US. So keep an eye on those. If you happen to own shares or you happen to be planning trades on those stocks, earnings are about to be reported today, okay? Cool, so let's begin with our options lesson. Why? Because actually it's perfect timing. When I get after the lesson, I'm going to get into the analysis of the markets, understand the Russia-Ukraine conflict. How does this impact the market? I just talked about this also equals opportunity. Well, guess what? Many of the opportunities that could be actually taking advantage of in days like today are actually through the use of selling options. So it's a perfect lesson today, because not only we are going to learn about selling options, but then we're going to see real-time applications of what can be done in situations where the market is very volatile. And I just mentioned that this equals opportunity, but it also equals risk, enhanced risk. So by selling options, we're going to be able to build ourselves a cushion that generates a certain degree of room on the price charts that allow us to be wrong to a certain degree. So if the market was to move against us because of that volatility, we can survive that to a certain degree. Of course, there is nothing in trading which is free money or risk-free trading. That does not exist. But certainly we are going to explore situations with selling options where you're going to be able to create that cushion, that buffer that allows you to be wrong by a certain amount and still be okay. So we're going to talk about this because it's indeed very, very impactful for traders. So the title for the lesson is Why Selling Options Can Be a Smart Thing to Do and How It Differs from using shares of stock. Now, notice it also says selling options is a counterintuitive thing to do, okay? Again, I'm going to get you thinking to this. That's why it's very important that you are interactive with me on the chat box, because I will have a few questions throughout the lecture time I want to make sure you collaborate, you work with me on giving me some answers when I ask you questions, just to make sure you get it, because it's not going to be a difficult lesson at all, but it will be counterintuitive. So it'll be at times just slightly on the challenging side, which then you will appreciate it very much, you'll see. But in the meantime, I do need your focus, okay? So please work with me on that, okay? And by the way, I'll start with the first question, not related to options, which is, how many of you, just type yes on the chat box, for example, how many of you have ever shorted stocks? Like, because buying shares, buying stocks, or in other words, being long stock, it's normally the action that most stock traders or stock investors would do. So I am curious to know today in the audience, how many of you had experiences before in the past where you have been shorting shares of stock, betting on profiting when stocks are falling instead of betting on when the stocks go up? Okay, so please go ahead and type something quick on the chat box. Yes, short, me, something like that, so I know that you have done it or you haven't. Okay, very good. So yes or no, very good. Thank you for that. Thank you for those feedbacks. I'm just reading little by little. Now, while I'm reading your answers, quick review from last week for the ones of you that missed it, or for the ones of you that you are new to options trading and you kind of got it last week, but we learned through repetition. So I'll repeat this very quickly. What are options? Options are a tradable instrument. They can be used for all sorts of trading, long-term, short-terms, anything in between. Options prices are what we call a derivative asset, which means that when you trade options, that tradable instrument you trade, it's a contract. You buy it or you sell it, and you pay a price, or you receive what's called premium. So that price you pay when you trade it, that price derives from the value of a stock, which is the underlying asset, which here, in order to simplify, I'm calling it the link asset. So if you trade options on Apple, you don't trade Apple. But when you trade options on Apple, because the options on Apple, they are linked to the price of option, to the price of Apple. So if Apple moves either up or down, that will have an impact on your trading results. Thank you so much, by the way, for those answers. Okay, I see the yeses and the nos, and that's very, very appreciated. I appreciate that. It feels like a little bit like we have a little bit of a mix, okay, of some of you that have done it and some of you that haven't. So now, question for the ones of you who have shorted before. Okay, question for the ones of you who have shorted before, which will lead into the application of selling options. Was it counterintuitive the first time you did it? It was kind of weird that you sell a stock without owning it, right? That's shorting, right? You sell the stock without owning it, then the stock falls, then you buy it back, and then you return it, right? So was that an intuitive thing to do? Or was it kind of like, let's call it weird? It was counterintuitive, right? Please confirm that to me on the chat box if it was intuitive or counterintuitive. But then also the second question for you is, as you did it a few times, did it start feeling like a normal thing to do? Or that counterintuitive thing remains as counterintuitive, or after you do it like 5 times, 10 times, it's like, okay, I get it. I short, the stock falls, I make money. I go long, the stock rallies, I make money. And of course, if the stock behaves the opposite, then you lose money. So please answer this question if that's okay, so I can get that feedback from you guys. So let's continue with the review from the last week. So options trading contracts, and those contracts have expiration dates. Again, speed of the light review of what we learned last week. So when you trade stocks, long or short, you can stay in this trade forever. But when you do an options trade, even if you wanted to stay on the trade forever, there is a moment in time where the options contract expires, and then you have to take a decision where you have choices to stay on the trade. You can do what is called rolling the options contract. So you can do multiple things. It's not like that's it, it's over. You can roll it and extend it. But by definition, those contracts have expiration dates, which is a big difference, which, by the way, is going to work in our benefit big time in today's presentation as we sell options, as you will see. It was weird, it felt abnormal. Yeah, the webinar will be around 45 minutes to 1 hour, something like that, Tagore Master. Thank you for that feedback again, my friends. Now, the other thing that we said is that we had 2 types of options, right? We got the calls and we got the puts. And again, I'm reviewing what we covered last week. just to make sure everybody follows today's lecture. And what we said last week is that, look, when you think of call options, you want to think about picking up a phone call, because when you pick up a phone call, the movement of your hand is going up, right? So in other words, that is an easy way, a kind of like a reminder, right? A little trick to remind yourself of what a call does when the stock goes up. When the stock goes up, calls gain value, right? So pick up the phone call. The hand goes up, the call goes up. In other words, when you buy a call, and let's say you buy calls on Apple, and then Apple goes up, then you will make money on the calls, because the calls will change value based on the price of Apple to the upside, because the calls gain value as the stocks are headed up. That's how they are designed. The puts is the opposite. So now we are thinking about put the phone down, meaning that as the market goes down, that's how the puts gain value, right? When you put the phone down, the direction of your hand is going down, and that is how the puts gain value. So they are the complete opposite, right? They are the inverse. Puts are the inverse of the calls, or the calls are the inverse of the put. Okay. So this is what we have. Okay. So in this sense, last week we talked about what happens when you buy a call and the stock goes up, which is that you profit. What happens when you buy a call and the stock falls, you lose. We said, great thing. The most you can lose is what you pay for the call. So it's like you have a stop loss built in, right? So it was a pretty safe trade. It was pretty interesting when we learned that last week. When you buy a put, the same happens, but in the opposite direction. If you buy a put and the market collapses, you make money, right? Notice what I said. You buy a put and the stock collapses, you make money, right? Of course, if you buy a put and the market goes up, then you lose money, but good news, the most you can lose is what you pay for the put, which is much less than the value of the stock. So again, it's a pretty safe approach to trading. It's like you have a stop built in. Even if the stock gaps against you, like 20% against you, the most you can lose is what you pay for the put or the call. So it was a pretty interesting approach, what we learned last week. Today, we're going to reverse it. We're going to talk about what happens if you sell the call and what happens if you sell the put. And in this case, I'm going to have two questions for you. Okay. Question number one, and please feel free to interact in the chat box. Question number one is, what happens when you buy? When you buy anything in life, a house, a stock, a call, or a put, it doesn't matter what. When you buy, do you pay or do you get paid? That's question number one. And question number two, and please, on the chat box, type one and then the answer. Okay, so do you pay or do you get paid? So one pay or one get paid. And then question number two is, when you sell something in life, okay, when you sell something in life, you sell a house, you sell a stock, you sell a business, you sell a call, you sell a put. When you sell something in life, right? Question number two, what happens? Do you pay or do you get paid? Okay, what happens when you sell something in life? Okay, very good. I can see the answers coming in. So answer to question number one, very good, everybody. You pay. Okay, the straddle or the strangle, Artem, we can talk about this later in the presentation if you don't mind. But basically, you can buy the straddle or buy the strangle, or you can sell the straddle or sell the strangle. And basically, you know, what we're going to discuss today is selling. So later at the end of the presentation, if you remind me, I can tell you how would this apply to the strangle or the straddle. Okay. Right now, I'm going to start the lesson by talking about one unit at a time. Okay, sell the call or sell the put. Your strangle or straddle is selling the two together at the same time. Okay, which is options give you options, isn't it? Cool. So question number two was answered perfectly. Thank you so much, my friends. You get paid. When you sell options, you get paid. So what's the beauty of being paid? Well, I guess we all appreciate being paid. Okay. Many people get a job to be paid. Many people own property and put tenants on the property to get paid. Many people own stocks and they collect dividends to get paid. So I guess we all appreciate being paid. Now, the problem of being paid is that the most you can make is what you got paid, right? Where when you buy a stock, if the stock goes to the infinite, you make infinite, right? But when you sell something, you get paid, and that's the most you will make. Okay, so pros and cons in life. Like everything we do in trading, in business, in everything we do in life, in trading, everything with pros and cons. The last week we were buying options. What's the bad news? You have to pay for them. Okay, what's the good news? The most you can lose is limited, and if the stock goes to the infinite, you make infinite. That was a great thing. Okay. What are we doing this week? This week we are learning about why would you sell options, which, by the way, today market environment with the Russian crisis, it's very likely, as you will see later, a very good environment to sell options. You will see why. So what are we talking about today? We are talking about selling options, calls or puts. What happens when you sell options? You get paid. Now, bad news, the most you will make is what you get paid. Okay, but good news, you get paid. And because you get paid a certain amount, now you could afford the stock to go against you by that amount, and you're still breaking even. Of course, if the stock keeps going against you even more and more and more, now you're going to get hurt. There is no free money. There is no risk-free, anything that is serious in trading, okay? But it's a nice one when you get paid ahead of the trade, because now if you're right, you're gonna make that profit, which is what you want. But if you're wrong, now you have a buffer that allows you to be wrong, which is just as large as the premium collected when you sold the options, okay? Which is what you guys answer very well. When you sell options, you get paid, okay? So let's get deeper. So last week we talked about focusing on direction and betting on where the stock is going. Today we're going to talk more about what if we think about where the stock is not likely to go. Okay, it's a different approach. It's a different approach, and you will see that on my charts real time in a moment, and you will understand where I'm going with that. As we said last week as well, the normal thing is to combine options contracts in one trade. So normally you would not buy a call and that's it, or buy a put and that's it, or sell a call and that's it, or sell a put and that's it. Normally you would do what we call option spreads, buy a call, sell a call, sell a call, sell a put. You would do combinations, okay? A moment ago on the chat box, we had the term cover call. That means that you own the stock and you sell a call at the same time. So it's a combination. Again, today, since the second session that we do together, I'm keeping it basic, and I'm talking about what if you sell an option by itself. We will certainly conduct more advanced sessions one at a time in the future, and I'm happy to get as deep into the materials as you guys want me to. Okay, I love this, believe me. So you guys tell me how far you want to go. So what is the sell application? And this is the last slide. Okay, I'm gonna jump into the charts right now. What is the sell application that we're going to discuss? Well, let's say your outlook is bullish. Okay, I'm going to start with a bullish example because it's easier to think about. Most people think of bullish as something more intuitive and bearish as more counterintuitive. So let's say you are bullish and you want to own shares from a stock. Maybe because that stock pays good dividends and you're like, you know what, I want to own that stock so I get dividends. Let's say that's your trading plan or investment plan. There are millions of ways on how to trade. This is just an example. It could be many other things. So you can just go ahead. Option one, buy shares. And now you own the stock. And therefore now you have all the risk attached to such ownership. Nothing wrong with that. But you need to understand that the moment you own a stock, the moment you own a property, you have the risk, which is equal to the value of the asset. Normally a property will not go to zero unless there is, I don't know, crazy situation, an earthquake, I don't know, something crazy. But stocks could go to zero, isn't it? I mean, depending on the stocks you trade. If you trade very stable companies, probably not, but it could still happen. You can think of the financial crisis in 2008, where companies that no one expected went to zero. So these things could happen, and owning the asset has that risk. But another possibility is to sell the put option. Now, here we got a double negative. We are negating the negative, which is positive. We said the put is the opposite of the call, right? So the put gains value when the markets are falling. So if you buy it and the market falls, you make money when the market falls. But what if you sell it? Well, if you sell the put, you're going to make a profit only if the market rallies, not if the market falls. So selling the put is like negating the negative. It's counterintuitive, which is what I said at the beginning part of the presentation. But when you do it a couple of times, it's pretty clear. And you will see that in the example in a moment. So if you sell the put, you get paid. Remember, when you sell something in life, you get paid first. So you will receive a premium payment. And of course, you will do that in exchange for something, which is acquiring the obligation of having the stock be put to you. That's why a put is called put. Okay, you acquire the obligation to buy the stock. That's why you get paid premium when you sell the put. And if you were to be obliged to buy the stock, then we say, options traders, we say the stock has been put to you. So you got paid premium to acquire the obligation to purchase the stock, which you want to own in this example, because it pays good dividends, for example. But think about it. Instead of buying the stock, you don't buy the stock. You sell the put on the stock you want. So you get paid first. And then if the stock is put to you, then you own it, which is what you want, but you got paid first. And because you got paid first, an X amount of premium, so now you are able to see that stock go against you by a certain amount, and you're still okay, because the amount of premium paid is acting as a buffer that allows you to be wrong by that amount. Enough about words. Let me jump into the charts so I can show you this properly. So these will be understood much better. And I can see some questions coming in. If you don't mind, guys, let me go over example number one. And please keep typing, okay, because I will review the questions later. But I would like to be visual. This is the time to be visual and jump into the charts and show it to you so you will understand this much better. How is it going so far, everybody? Could you please, from 0 to 10, being 0, you are totally lost, and 10, you are following. Could you please type a number from 0 to 10? 0, you are totally lost. 10, you are following. So I know where you're at. Please go ahead. Wonderful. Yes, and also don't miss that commission card, guys, that is being shared with you on the screen and the chat box. Okay, this is very, very kind. Don't miss it. So I'm gonna share my screen, which means that my video stream will go away. So you will only see my charts. You will not see my face anymore. I guess it's okay. The chart is gonna be more important. So please bear with me just one moment. I am about to be there, sharing my screen with the charts, and the charts are now here. Here we go. So here are the charts, okay? So I'm gonna look at a stock called Caterpillar, okay? So Caterpillar is a very large company in the US markets, okay? I believe that everybody sees my screen right now. I'm looking at Caterpillar. You know, the way I found this stock, and the reason why I'm looking at this stock is because that stock it's inside of what we call a speed bump, and also that stock also belonged to a group. You may want to think of groups as a sector. Within the long term, the group is strong. So I'm not looking at any stock. I'm looking at a stock that, while the stock is falling, the stock belongs to a strong group. And let's say, following the example we had on the slides, let's say I want to purchase that stock. So how can I manage this trade, but using options instead of using shares? Well, the stock is currently, as you can see, falling, and not only falling, but actually that stock is coming into a green UFO, which stands for unfilled orders. Okay, so that means that there are buy orders waiting to get filled there, which likely would create a bounce on that stock going higher. Of course, this is not guaranteed because unfilled orders could be canceled. But those unfilled orders are very well located too, as you can see in prior cases. Like, for example, if you were to look at this case, when the market was falling, price came into the speed bump and bounced. When price came into this bottom part, price came into this speed bump and bounced. So now if you look at the current speed bump there, so price is in a speed bump, so it's likely going to bounce. Okay, and not only that, if I was to look at what if it doesn't respect the speed bump and goes lower, so if I look at that bottom part, so if that stock falls lower from there, it should go back higher. Okay, so let's say I'm looking at this and I'm like, look, I would like to buy Caterpillar, but if I buy Caterpillar now, it may continue falling, and then it's a problem. And also, if I own the stock, I have the risk of owning the stock. So what else can I do? Well, take a look at the chart, right? If you look at the chart, because of those speed bumps, because of the UFOs, I guess I made my point that, there is a pretty technical possibility. Again, it all depends on your trading plan, but that's how I trade. So there is a technical opportunity there for that stock to turn around and go back higher. But think about it. I would love to get it here because it's inside of a UFO, but I would like it down here way, way, way better, because instead of one UFO, I got 3. So the quantity of buying that should happen starting at 165 is amazing. So what I would like to do, instead of buying the stock now, and keyword instead, okay, so instead of buying the stock now, okay, I want to explore what if I sell, I said sell, not buy, I sell a put option, and to be more specific, what if I sell the 165 put? Because selling the 165 put, what this would do is that it would put the stock to me at 165 if the stock falls to 165. So let's understand the what if scenarios. If the stock is currently trading at 186, which by the way is not going to be 186, it's going to open lower. Current price it's 183. The pre-market is 183. So the stock is going to be deep inside the UFO, which is fantastic. So when the US market opens, because of the Russia conflict, the market will up and down. That stock is going to be somewhere in here. So buying it here, based on the way on how I trade, is not a bad idea, but buying it at 165 is way better. 3 times more buying at those price points. So I would love to have that stop. Let me rephrase that. I would love, based on my trading plan, to have that stock put to me at 165. So if I sell the 165 put, I am going to get paid X amount of premium in order to acquire the obligation to buy that stock at 165, which, by the way, that would only happen if the stock falls to 165. If I was to sell the 180 put, then I would acquire the obligation to get the stock put to me at 180 if the stock was to fall to 180, right? So I'm choosing 165 because this is where my UFOs are. Again, this is how I trade. You could apply the put strikes. We call these strikes 165, 170, 180, whatever price it is, we call it strike. So you can apply your trading methodologies, whatever they are, and select the strike of your convenience. In my case, 165. So what happens if I sell the 165 put? Okay, so I'm going to load an option chain on a CAT, Caterpillar. Just to make this simple, I'm just going to focus on January 2023. Okay, so I'm looking at the expiration date of January 2023. This is 330 days from now, so almost a year. So we'll be able to kind of evaluate the yearly return of doing that. And here is the 166. Here's the 165 put. Notice on an option chain, the puts are on the right put, the calls are on the left. So we ignore the calls right now. We are selling a put, sell the negative, negate the negative is positive. And therefore, you would sell the 165 put. Well, the market is closed now, so it's not showing data here, but the last price traded for that put was $13.28. So $13.28, this is how much I would get paid if I was to sell that contract. And by the way, in options trading, everything is to be multiplied times 100. So that means that I would collect $1,328 if I did this trade, when the market was open before it closed yesterday. Today at the open is going to be more because the market is going to fall. And remember, put the phone down. When the market falls, the puts gain value. So you will be able to sell it for more, maybe 15, right? Whatever it is, we'll see it at the open. But let's be pessimistic. Let's say it's that amount. Well, if you sell it at that amount, so you're going to make $13.28 in premium collected out of acquiring the obligation of buying the stock at 165 times 100, because every options contract represents 100 shares. So 165 times 100 will require $16,500. So in other words, if the stock is put to you, I'm looking at worst case scenario. If the stock is put to you at 165 because the market kept falling all the way from 186 to 165. You will need to fulfill your obligation to buy the stock at 165, which is what you want in this example. And to do that, you need $16,500. If you do this in a cash account, if you're using margin is half, let's pretend you are not using margin, so you need 16,500. So in other words, you're gonna make $1,328 out of using $16,000 of your buying power. That is around 8% return in 330 days until January 2023. If I analyze it, times 365 divided 330 to annualize it, this is kind of like almost 9% return, right? For an investor, this may be okay. Again, this is going to be way more when the market opens because Caterpillar is going to fall. So instead of 13, you're going to get paid 15, 17, 18, whatever it is, it's going to make, instead of 9%, maybe it's 15%. Again, I cannot predict the future. We'll see it at the market open. But basically, you get paid premium. And now that premium represents around 9% return. And now let's understand the what if scenarios. So what if scenario number one? Well, if the stock from here goes back higher and anywhere in January 2023, the stock is above 165, even if the stock goes higher, and after going higher, it goes lower and then higher and whatever. And on January 23, the stock is trading at, let's say 165.10. Guess what? The 165 put will expire worthless. You will not be obliged to buy the stock because it's above 165. The stock won't be put to you, and therefore you made 9%, even though the stock dropped. How much the drop would be? Well, from 186.67 to 165, we're talking about a $21 drop out of a 186.67 price. That is like 11%. So the stock went against you by 11%, and you made 9% annualized rate of return. That's the buffer you create that allows you to be wrong by a certain amount. Okay, of course, there are more what ifs. Okay, there are more what ifs. Feel free to comment. Okay, I see your question, CD investing. What if it drops to 160? I'm getting there right now. So, so what if number one? What if the stock goes up all the way? You make 9%. What if the stock goes up a little? You make 9% in a year annualized. What if the stock goes flat? You make 9%. What if the stock goes down by a bit? You make 9%. What if the stock goes down almost to 165, but does not reach 165? You make 9%. Okay. Now, what if the stock drops below 165? That's the important one, my friends. What if the stock gets to 165 or below? Well, now the stock is put to you, which is what you wanted, because it's a stock that belongs to a strong sector. In my assumption, based on the slide example, the stock pays good dividends. So again, do not sell puts if you don't want to take ownership of the stock. The whole scenario that led me to discuss this example with you guys is you want ownership of the stock. Okay, that's why you sold the put, because now you acquire the obligation to have the stock put to you. If you don't want the stock and you sell a put, you are making a very big mistake. There are option strategies that allow you to profit without owning the stock. We'll talk about this in other sessions. The one I'm discussing today implies that when you sell the put, you are authentically interested and willing to acquire ownership of the stock. Hopefully I made that very clear because it's a critical statement, okay? Now, so the stock came to 165 or below, so now the stock is put to you. It is not a bad news because you wanted it. Of course, if you didn't want it, then that's a bad news. So don't do it. Don't sell puts if you don't want the stock. I say it one more time. That's how important that is. I think I said it 3 times. So I guess that's good enough. But now what happens? Well, let's do a little bit of math now because, yeah, the stock got put to you, right? So the stock got put to you at 165. So you now own the stock at 165. So you got $16,500 involved in this trade, okay? So you own the stock at 165 because it's 100 shares, okay? Every options contract represents 100 shares. So you own 100 shares at 165, right? But you also keep the $1,328 collected. You don't have to return that. That's yours. You got paid $1,328 to take in the obligation to have the stock put to you. Now the stock is put to you. Great, you own the stock, but you also keep the premium. That is not something for you to return. You keep it. So in other words, you could think about this from a point of view of your net cost basis for the stock. Your net cost basis for the stock is diminished. Okay, from 165 to 165 minus 13.28. Okay, so your net cost basis now is, you know, I mean, let's do, I mean, it's very simple math, but just to make sure I made no mistake. So your net cost basis is 151.72. So question that we had earlier, I don't see it on the chat anymore. Maybe, oh yes, CD investing. You said, what happens if it drops to 160? Well, if it drops to 160, you are still ahead of the game. You are making $8 and you know 38 cents and 28 cents. Okay, you are making $8.28. You are still making $800+. Why? Because while the stock was put to you at 165, you kept those $13.28. So again, you are creating a buffer that allows you to be wrong. If the stock is not put to you from that current price all the way to 165, you have buffer number one that allows you to be wrong. The stock could be whatever, as long as the stock is here or above, you make money. Okay, in other words, above 165, you make money. If the stock goes below, now you have a $13 buffer number two below 165 that allows you to not to be in a problematic situation for an additional amount of $13.28. Of course, if the stock now keeps falling and drops to, let's say, $80 per share, well, again, your net cost basis was 151, right? 151. So if the stock drops to 80, now you are losing $71. So for sure, the moment you own the stock, you want to use stops, you want to use options against it. You can do what we call an options collar strategy, for example. So you can do many different things to help the stock to be safe. But the moment you have a stock that is put to you, you are in a stock trade. This is not an options trade any longer. The only benefit is that you got a price reduction, which is providing a very significant advantage. Very good. My friends, this is, again, we can talk about this forever, okay? But we also need to do market analysis in such an important day today, which is, you know, the craziness that is happening out there. I mean, the session SMARTT stands for Special Market Analysis Report for Tiger Traders, right? So we are supposed to do a good market analysis no matter what, but more than ever, today is going to be very special. So I'm going to switch from lecture time to market analysis. Be ready, my friends. This is going to be very relevant. But also, of course, I want to know, how did it go with the lecture time? We'll have more lectures. We'll learn through repetition. If this was new to you, if this was counterintuitive, I kind of warned you before we started, isn't it? Watch the session again, I would suggest. Okay, this will help you to internalize and digest the information. Feel free to send me an email if you have questions. And by the way, at the end, I'll give you additional tools and help for you to learn this more and better. But in any case, we'll have more sessions as well, where I will keep adding more lecture time that will help you to understand how options work in all angles. Okay, so no worries, but please let me know how it went. Okay, it is wise to sell put on a 1 to 2 day expiration, far from at the money. The quick answer to that, CD investing, is it depends on which markets and what do you mean by far, because far to one trader could be outside of a Bollinger Band, far could be 280 hours away, far could be, you know, it depends. Okay, it depends on your trading technique and what market, and most importantly when as well, because options fluctuate in value. There are times where they are inflated, there are times where they are deflated. So we need to have a deeper conversation about that. Happy to have that conversation another time, if you don't mind, since we need to now do our market analysis. Okay, but I love the question. Very, very good one. Cool. So multi-dimensional analysis. Okay, so we're going to start with the market climate, okay, as we have done before. So let me switch now from Caterpillar, CAT, to SPY, okay? SPY being the S&P 500 ETF on the left, but also I have the S&P futures in the middle. And as you can see, the S&P futures is down by 2.31%. So everything is crashing. Well, I should rephrase that. Certain markets are crashing up, certain markets are crashing down. Let me move from our top platform to TradingView. And let me go over a few markets. For example, the S&P, okay, S&P futures on the left, crashing down, okay, again, 2-point-something% going down. What about crude oil? Going up, speed of the light. Crude oil is up by 7.7% as we speak on the futures markets. This is light crude oil. This is WTI. It's not Brent. Very similar correlated market. So oils are up big time. Gold is up big time. Huge movement on gold. Huge, massive, massive, massive. The dollar index is up 1%. Think about it. The most liquid currency in the world, the currency that is being employed in 80% of transactions worldwide, is up by 1% today. This is massive. What about the Bitcoin? Okay, Bitcoin is down by 6-point-something% today. Many people keep talking about cryptocurrencies as a safe haven. Well, I would say not in front of a war. And I don't mean to contradict other traders' opinions or market analyst opinions. I just mean to represent what the chart means. If you look at gold, in case of a conflict, look at what's happening. If you look at Bitcoin, I can see something very different is happening. So the definition of safe haven in certain aspects will need to be revisited, as the markets are changing nature. The markets are dynamic, okay? And what you don't want to have as a trader, and that's why we use AutoClimate, what you don't want to have as a trader is a belief system which is rigid, where you always and only think markets behave in a certain way. Because gold, that was not a safe haven for a while, is now behaving as a safe haven. And the opposite is true for Bitcoin. So you want to have this dynamic approach to the markets. That's why we are doing a smart market analysis, so you understand what's happening out there. European markets crashing like crazy. This is the Eurostock 50, down 4.6%. Okay, pretty strong. Singapore, okay, Singapore. Well, this is not a futures markets. What I'm charting right now is just the index. So you can see the price action today. It opened gapping down, then came back up, ended up negative 0.22%. So it doesn't, it seems that the impact was not felt too badly. But what about in the futures markets of the Hang Seng? Okay, well, this Hang Seng right now, real time, is down by 1.57%. So again, you can see how the Russia-Ukrainian conflict is, if any, the least we can say, is generating a massive level of volatility. Okay? And I'm going to come back in a moment to talk about volatility and talk about the VIX, which is gapping up all the way to 37%. So I'm going to come back to this and explain what's the VIX, because that's options data. So I need to explain what that is. And this, by the way, will be related to your question, CD investing, about selling options intraday. Okay? So now, what is going on with the climate and the market cycles on the S&P, where we started an Elliott wave on that candle? The Elliott wave has not been reached. The Elliott wave is all the way to down here. So there is room for the market to keep falling. The market is likely going to fall and open here, gapping down at 411. So there is still, at 411, there is still room to get to the orange area. So there is room for the S&P, the largest equity index market in the world, to fall. And therefore, everything that has to do with options would be impacted. From an AutoClimate point of view, we are reaching, a normal stage of the climate, 3 out of 3. 3 red dots, 1 standard deviation signifies that a normal thing to happen is 3, and we got 3. So starting from now on, if the market keeps falling today and tomorrow and the next day, we are now stepping into less likely territory, meaning that from one angle, statistics would suggest the market in the following days will have a tendency to turn and come back higher. Okay, so why? Because the market has been falling a lot already, and a lot, if you look at this value here on the left, 1.59 is a 2 standard deviation of a climate. And we already reached yesterday 166. That's what I call too far, too fast. 166 being more than 159, which is a statistical measurement of price movement. That means that the market has been going down at a speed which is faster than what a 2 standard deviation of the cases is. In other words, the market is falling hard, not a joke. And today is going to open gapping down, which is going to bring this value even higher. So typically when a market is falling or going up too fast, typically we are entering a non-sustainable situation. We all know the famous quote of Wall Street that says the market could remain irrational longer than you could remain insolvent. So please, everybody, note of caution. I am not telling you, everybody, go ahead and buy everything. Absolutely not. The market is falling. The climate is red. You gotta respect that. There is fear in the market. The market is falling until proven otherwise. And this red dot changes to blue. And by the way, last week, I granted access to all of you who wanted to use our link to get access to AutoClimate for free on TradingView, right? So if you missed that, watch the video from last week or send me an email. I'm happy to help you to get access to this tool. But until we get blue, we gotta be very cautious because the market sentiment, the market environment, the market climate is down. But while it's down, it's falling too far, too fast, which is often the reason when markets turn in an instant in the opposite direction. Think of 9/11 in the US, think of the war in Iraq. When you look at statistics, there was a beautiful article published in the Tiger Broker community today talking about what happened in prior wars. There was a beautiful article that showed how a few days later, a few months later, where was the market? And in most cases, the market was higher. So conflicts like what's happening right now, it's terrible for humankind. It makes us all sad. And obviously, we are probably not very happy, isn't it? But from a trader point of view, you wear your trading hat. And what does that mean? Opportunities are on the corner. Let's be wise, let's be smart, let's be safe to find the opportunities that make the most sense. So it's a time for us to watch the market. And whenever there is a sign of a climate change, probably this is going to lead to beautiful opportunities to trade in the opposite direction. But so far, expect a very strong, violent move to the downside today. This is what the climate suggests, okay? As well as the Elliott wave, which still has room to continue going lower. From an on-field order point of view, that's the same suggestion. When you look at the S&P futures, it's all red UFOs. It's only sell on-field orders, what we see on the chart. When you look at the S&P ETF, SPY, is all red UFOs. We don't have green UFOs like we had last week, okay? That created moves of this sort. We didn't have any of that, okay? So until we see green UFOs on the screen, again, we don't have evidence enough of buy on field orders coming into the market, and therefore it's going to be difficult for the market to turn with conviction. So again, it's a moment for us to watch, to get ready for opportunities that are probably around the corner, but with a very, very strong note of caution. I'm saying this. From a volatility point of view, notice in that screenshot how the red line is between the blue lines. Let me explain what that means. This is our probability cone. So the probability cone suggests where the market may be based on volatility measurements in a future date. For example, if you were to look at, a Friday, February 25, okay? So the market could be as low as, around 411. Okay, well, guess what? The market will open at 411 already. So this is telling you how the market is really moving very violent. That was the reading and the calculation yesterday at the close of the market. So today the move is already reaching that statistical measurement. So that's very volatile. But here's what's most interesting. Okay, and I'm gonna go back to the VIX now and back to CD investing. Okay. So this is what's very interesting. The red line is beyond the blue lines. On the screenshot I had here, it was in between. So what's the red line? The red line, and guys, we are almost hitting 1 hour in the session, okay? But again, it's a special day today. Bear with me, guys, because it's an important day. If you have to go, of course, there is a recording out there, okay? But I'll keep going for a little longer if you don't mind, because it's a special day indeed, okay? So the red line represents the implied volatility of the options. which is kind of the same as the VIX when looking at the S&P 500 index. Each stock has its own implied volatility. I won't discuss that today, but the S&P has its own volatility, which is the VIX. And that volatility measurement is coming from the options prices. It's not coming from the market, it's coming from the options on the market. What does that mean? Think about it. Let's say many people expect a very big move to happen, either up or down. Well, people can act on the calls or the puts, depending if they expect the move up or down. So if many people expect a big move to happen, what's going to happen? Many people are going to be buying either calls or puts. And if many people buy calls or puts, you're going to have a lot of demand for those calls or puts. And if you got a lot of demand for those calls or puts, what's going to happen to the price of such calls and puts? It's going to go up. It's going to go up in a massive way. Calls and puts are going to get very expensive even if the market is closed, which is what's happening right now. The VIX is gapping up, representing the fact that the implied volatility, which is a measurement of pricing in the options, is going up, right? Options are becoming overpriced because of an excess of purchasing on those options, probably in this case, obviously, I would say in this case, because of an excess of fear, given the geopolitical conditions with Russia and Ukraine. And therefore, options are becoming very expensive. Very expensive. Well, think about it. What did we cover today in the lesson? Selling a put. Please answer this question on the chat box. One of the most important questions of today. When you sell a put, would you like the put to be expensive and sell an expensive put and collect juicy, hefty amounts of premium for you? Or would you like to sell a cheap put, an underpriced put that pays you very little premium? What would you want to do? Okay. Option 1, sell an expensive put. Option 2, sell a cheap put. What would you like to do when selling options? And remember, this is counterintuitive. Please answer that question. And I'm going to come back to the VIX and your answer in a moment. And you will understand why I said that the market conditions today are indeed quite unique and provide great levels of opportunities that we need to take with lots of care and caution, because volatility is also danger, but indeed also opportunity, as you will see in a moment. So what else can we see here? The implied volatility comparison, looking at the blue line and the gray line being blue, the implied volatility of the calls is kind of like the VIX for the calls, and gray, the implied volatility for the puts, kind of like the VIX for the puts. So on my screenshot, you got the blue above the gray, but on the real-time markets, you got the gray above the blue. What does that tell you? It tells you that the puts are more expensive than the calls. And you guys said it perfectly. You want to sell expensive puts. You want to sell the puts when the levels of premiums are juicy levels of premiums, hefty premiums. So you collect great amount of what we call credits in options trading, which allow you to create a greater buffer that allow you to be wrong. And coming back to rates of return based on the lesson today, see, instead of making $13.28 out of a stock which is trading at 165, right, which we annualized, and that was 8.9%. Do you remember that formula earlier? 9% return. So if the premiums are inflated, right, which is going to be the case today big time for most of the assets in the market, including the commodities such as oil, gold, that are going up, doesn't matter. Premiums will also increase. So options are going to get expensive across the board. So what's going to happen? So instead of collecting $13.28, you may get $20, right? And $20 again, $16,500. And this is an estimation, okay? But you get my point. So now instead of making 9% annualized, now you are making 13% annualized, okay? 13% annualized, which is, you know, like 20, 30% extra because the implied volatility went up. And the implied volatility is now, the implied volatility, which is the VIX for the S&P, is now trading at 38.77 in pre-market, okay? So great level of premium a great opportunity to see those stocks falling down into UFOs, into speed bumps, where the premiums are inflating, so you can sell very expensive puts below price and be ready to get stocks put to you at very low prices in an environment where after a war, market cycles often show that after a few weeks, a few months, the markets go back higher. But again, I'm not saying buy it at the current price, because we would expect, based on the climate, the market to go down. Well, to absorb those stocks to go down and not to be heard, the application of to that selling puts is indeed advanced and very useful. Okay, but now, having said all of that, I do want to emphasize very much, because this is, if you are like me, if you are an excited person about trading, I'm very passionate about trading, I love it. So you may go ahead and be like, okay, let's sell puts now. Wait a minute. Remember, you are taking in the risk of getting the stock put to you. So make sure that whatever put you sell, you want to take delivery of the stock at that price. Don't do it only because I said puts are inflated, you get great premiums. Well, that's true, but you also get risk. If the stock is put to you and then the stock drops a lot, then you lose money. So you have risk attached. So make sure you know what you're doing, and just think about what I said with care, because the trading is a serious matter, and we don't want to gamble out there just because today you're learning something new, which is exciting, which indeed is exciting and powerful, but you gotta master it, and you need to know what you have in your hands in order to be safe. So please be safe, everybody. Okay. Now, what else? The volume maps. So when we look at the volume maps with options, and I'm almost done, everybody. So the volume maps, you can see how yesterday at the close, 5 times more puts. Remember, the gray color represents puts, the blue color represents calls. Yesterday, 5 times more calls were traded than puts. 6 times more, sorry, let me rephrase that. I said it backwards. 5 times more puts were traded than calls. 6 times more puts were traded than calls. 6 times more puts. 4 times more puts were traded than calls. And also, that little triangle represents the 5-day average of the put trading. Notice the volume went way beyond the average. Here's the average. Way beyond the average. Here's the average. Way beyond the average. Huge amount of put buying as an anticipation of the war getting in a worse condition. I guess someone knew something. Someone was expecting something yesterday before the US market closed. Massive bearish sentiment that is building up in the options market. So again, not a surprise. The markets are opening up and down around 2%, and many other markets are reacting to it, such as gold moving, like going to the moon, crude oil, other commodities such as natural gas also moving fast. Okay, and finally, when it comes to sectors and groups, again, we are really getting into a market environment which is very interesting. If I look at the groups, okay, and I look at long-term and mid-term, okay, and I zoom, let me sort these based on strength, and I zoom into this, okay, so you see it better. So notice that most of the sectors, utility, technology, consumer goods, consumer services, it's on the red. Everything is on the red, okay, everything is on the red. Basically, oil and gas and telecommunications and financial is fighting it. Those are the sectors to kind of watch, okay? So probably if you get to see stocks falling hard, and you are looking at gas stocks, oil stocks, telecommunications, financial stocks, you find good trade setups based on your trading plans, based if you happen to use UFOs, if you happen to use the same tools I use, based on all those different types of tools, finding stocks in those sectors probably is a safer approach to putting those trades together. And again, if you want to use those puts, selling puts at a lower price, could be a good way to collect premium, generate a rate of return, 9, 10, 8, 15%, whatever, depending on the premium levels, which today is likely going to be increased. And if the stock keeps falling, now you are acquiring stocks that belong to sectors where in the long term is blue. Okay, in the long term, those sectors are still technically strong, putting on the side of fundamentals, which of course, geopolitical events like what's happening today have the power to change everything. Next thing you know, 2 months from now, the whole distribution and sector rotation has changed to a totally different picture, because it may have really totally impacted the world. It could certainly be, okay? But again, all of this is to be assessed with the tools on the charts to trade based on evidence instead of trade based on a guess. Because trading based on a guess, it's good if you get lucky, but if you don't get lucky, it's the recipe for lots of risk. So at least my approach to trading, and I guess we're all different, it's to really focus on safety. Okay. So before we end, I said I had a bonus resource for you. So as you can see, learning options, implies that, we need to be ready to put a little bit of time and effort. So last week, I granted you access for free to AutoClimate. So you guys could consider utilizing that tool within the context of your trading plan to enhance or potentially enhance the power of how you trade. Or if you're new to trading, at least to start being guided into, what could be a good first step in your trading methodology. Today, what I'm bringing to you guys, and hopefully you will use this wisely. Today, what I'm bringing to you guys is 3 months free access to our coaching. We run, as you can see on this calendar, almost every single day of the week. We run live trading sessions, where the ones which are blue color are options trading sessions. We do 2 to 3 a week. So you are welcome to join us live during those sessions and see myself and other of the instructors in my team plan options trades, prepare options trades, discuss trading setups, discuss why this, why not that, answer your questions live, real time on the chat. And therefore, I am a firm believer that beyond knowledge, you need to develop skill, and you develop the skill through practice. But if you practice in a way that is isolated, you may develop bad habits you may not even know you have. So what's the best way to practice? Have a coach around you so you can ask questions, you can have trade reviews, etc., etc. So this is for this, and you have a 3 months access to it. And this is also thanks to Tiger Brokers and our collaboration. So you can thank me, you can thank Tiger Brokers, and both. I guess we both deserve it, but definitely very, very committed to helping you. So I'm counting on you guys when you join us in those sessions, or you watch them recorded, because they will also be recorded. I welcome you very much. I'm counting on you to be engaged and ask many questions so you can learn. And we also have a question page on our website. So if you attend the questions, if you attend the sessions recorded, you can also post your questions there, or even consult prior questions that were already asked on our website, and this hopefully will help you. Anyway, so quick summary here. You got 2 bonuses today. The one from Predictive with a coaching plan for free during 3 months. Please use it wisely. Don't be shy. And also a Tiger Broker that shared with you earlier your voucher to get this execution of option at no cost to help you also get started. And it's very, very nice of them. Anyway, so it's been 1 hour and 10 into the session. This is obviously not a normal thing. Normally, my goal is to keep the session around 45 minutes. Today is a very special day. I spent plenty of time on the lesson because it was counterintuitive, and plenty of time on the market analysis because it's a special day indeed. I am happy to attend some of your questions. We'll need to keep it short, obviously, because I already surpassed the time of the session. But for sure, if there is anything critical, guys, I'm happy to stick around for a few minutes. And I would like you to copy and paste one more time your questions, because there is a lot of scrolling and we need to be done. So if anything is critical, please copy paste one more time on the chat. I'm watching, and I'll be able to answer that. The options price move much quicker than the IV. Absolutely, because options are priced based on different factors. Implied volatility is one of them, but the price of the stock is another one. The time to expiration is another one. So depending on the option, there is something called the options Greeks. So depending on that, how reactive an option is going to be to changing its price is normally very much. Options are very reactive to price movement, which is very powerful for us to profit from it. So yes, very well said, Harisu. What else do we have here? The IV is higher, but the premium is cheaper. No, that could not be the case. That Ronnie, that would only depend on the strike you select. If you select a strike which is out of the money, then the more out of the money you go, the cheaper the option is the option premium will be. But while if you were to pick 2 scenarios, which is 2 strikes that are same distance, and one day it was low implied volatility and the second day was high implied volatility, and the 2 strikes are the same distance, when the implied volatility is higher, the premium is higher, assuming all the other conditions are the same, meaning same expiration date, same days to expiration. So again, implied volatility has a direct, massive impact on premiums. Okay, and by the way, there is also just for fun, I'll throw a smile on the screen. There is something called the volatility smile, which is a typical behavior. For example, if I load Apple, for example, here, so you will see how the volatility of options prices, if I load many strikes, okay, let me use SPY. So typically, the smile is not showing today, and you will understand why, but typically the volatilities would show something like that, which is like a smile. Today is not, meaning the calls are way cheaper than the puts. And why is that? Well, you saw it earlier here with the volatility comparison, where the puts are more expensive than the calls. That's why we don't have a smile, we have a frown on the options prices. But many times you go far out of the money. So look at this option here on the SPY. This far out of the money option is super expensive, 60+% implied volatility. Okay, so this is what we call price anomalies in options. Okay, so those are things that you need to practice real time to really understand. Okay, let me see. Is it possible to roll a call option infinitely? Yes, absolutely. You can just keep rolling. Okay, either when you buy them or when you sell them, you can just keep rolling. So when it's about to expire, you buy it back, sell a new one. Or if you bought the call, you sell the call you own, and you buy a new one with the next expiration date, and you keep rolling. You could do it. May not be the best application of options trading, depending on what you're trying to do, but definitely there is nothing to limit you there. So what's one key advice for today's market? Well, have a good methodology on how to find good stocks, have a good technical approach to understand what a good buying price for the stock is, which I use UFOs. Everybody, I would assume in the group, uses different techniques. And using that price, sell puts at that strike where you are authentically willing to get delivery of that stock at that price. And that way you are basically buying those stocks super cheap. If they don't go that low, you still make money in the form of premium, which is going to be a nice % of return per year. If the stock goes that low, it's put to you at the price you want it based on your methodology. And on top of that, you keep the premium that adds an additional buffer that allows you to be wrong. But again, one more time, that is only true if you are authentically interested in taking delivery of the stock. Please, no greed, no hope. Sell a put and hope for the best. You only sell a put if you truly want delivery of the stock based on your methods. Okay, guys? Very important. What if it rises to 180 in the middle of the year? You can buy and sell anytime. Yes, absolutely, Minion. You can buy and sell options, including intraday. So very good application. Let's say you sell a put, and then next thing you know, 1 week from now, the market is going up like it's going to the moon, right? Which could happen, even though the news in the market could be very bad with the Russian-Ukrainian conflict getting even worse. Maybe it was priced in and the market is going up big time. That could happen. So now you may decide, you know what? I sold a put that expires in January next year. I want to buy it back and close the trade. Can I do that? Yes, you can do it, including intraday. Very good, my friends. I'm gonna call it a day here. Again, very appreciative of your time with me, guys. Thank you so much, Tiger Brokers, for hosting the session so I can join the community and have a fun time with you all. Again, a bit weird. I went 1 hour 15, but again, today is a special day. I hope you don't mind too much. I hope that this was useful. Keep us in mind. My email is on the screen. Anything you need, use our website, use my email. We'll see you soon live again in the next SMARTT session. Take care, everybody. Stay safe. Bye-bye. See you next time.